Unshakeable by Tony Robbins. A WealthWorks summary. Introduction. Unshakeable. In 2017, Tony Robbins published a shorter, more focused companion to Money, Master the Game. Where that book was comprehensive, Unshakeable is urgent. It was written in response to a specific anxiety that Robbins observed everywhere. The fear of market crashes, of losing what you have built, of financial catastrophe arriving without warning. Unshakable is built around one central argument. Financial fear is the greatest enemy of wealth, not market downturns, which are temporary and historically always recover. Not inflation, not fees, not bad luck. Fear. The fear that causes people to sell at the bottom, stay in cash during recoveries, and avoid investing altogether. Robbins interviewed many of the same investors he spoke with for Money, Master the Game, focusing specifically on how the world's greatest investors think about risk, volatility, and downturns. What he found was consistent. The best investors do not fear crashes. They prepare for them, and they use them. Chapter 1, The Core Four, What All Great Investors Agree On. Robbins distills the wisdom of the world's best investors into four foundational principles. First, never lose money. This is not literally possible in markets. What it means is, never take risks that could result in catastrophic, unrecoverable loss. Preserve your principal. The mathematics of recovery from large losses is brutal. A 50% loss requires a 100% gain just to break even. Second, asymmetric risk reward. Look for opportunities where the potential gain is dramatically larger than the potential loss. Risk 1 to make 5, as Paul Tudor Jones described it. Pass on trades where the math runs the other way. Third, tax efficiency. Every dollar you keep from tax is a dollar that compounds indefinitely. The wealthy spend enormous effort on tax optimization. Not evasion, but legal structuring of investments in tax-advantaged accounts. Fourth, diversification. Not just across asset classes, but across time, dollar cost averaging, and across geographies. The action: review your investment decisions against these four principles. Where are you taking asymmetric risk on the wrong side? Where are you leaving tax efficiency on the table? Chapter 2. Volatility is normal. Corrections happen every year. One of the most useful chapters in the book is Robbins's historical survey of market corrections. He shows that a 10% or greater decline in the stock market happens in roughly 2 out of every 3 years. A 20% or greater decline, a bear market, happens roughly every 3 to 5 years. Most people experience these events as exceptional, frightening, and possibly permanent. The data shows they are normal, expected, and temporary. Since 1900, the stock market has experienced more than 30 bear markets. It has recovered from every single one. The investor who understands this history has a fundamentally different experience of a market decline than one who does not. Instead of panic, there is recognition. This has happened before. It has always recovered. If I do not sell, I will not lock in the loss. Robbins is emphatic. The single most costly decision most investors make is selling during a downturn. Every major study of investor behavior shows the same pattern. People sell near the bottom and buy near the top. The investor who simply holds, who does nothing during the crash, almost always ends up ahead of the investor who tried to manage it. The action: research the historical returns of a broad market index fund over any 20-year period, including the worst crashes in history. Then ask, do I have enough faith in those numbers to hold through the next major decline? Chapter 3. Hidden Fees, the Industry's Dirty Secret. Robbins revisits the fee issue from Money, Master the Game, but with greater specificity and urgency. He estimates that the average American investor loses between $100,000 and $300,000 over a lifetime to unnecessary fees. fees they are often unaware they are paying. He is particularly pointed about the fiduciary standard, the legal requirement that a financial advisor put their client's interests first. In many countries, financial advisors are not held to this standard. They are held to a suitability standard. They must sell you products that are merely suitable for your situation, not necessarily the best available. This distinction matters enormously. A fiduciary advisor must recommend the lowest cost index fund if it serves your goals. A non-fiduciary advisor can recommend a higher cost fund that pays them a better commission as long as it is technically suitable. Robbins's advice: work only with fee-only fiduciary advisors if you work with an advisor at all, and ask explicitly, are you a fiduciary? Do you have a legal obligation to put my interests first? If the answer is no or hesitant, walk away. The action: ask your financial advisor or broker whether they are a registered fiduciary. If you are uncertain, look it up. If they are not, research what moving your accounts to a fiduciary advisor would involve. Chapter 4: The Four Seasons Portfolio. All-Weather Investing. Robbins returns to Ray Dalio's all-weather portfolio, the asset allocation designed to perform reasonably in any economic environment. He presents it in more detail here than in Money, Master the Game. The logic: every economic environment can be described along two dimensions: growth increasing or decreasing, and inflation rising or falling. These two variables create four possible seasons. Different asset classes perform differently in each season. Stocks perform best in growth with low inflation. Long-term bonds perform best in low growth with low inflation. Gold and commodities perform best in high inflation. Shorter-term bonds and other assets provide stability. The all-weather allocation: 30% stocks, 55% bonds of various durations, 15% real assets, weights these asset classes to balance risk across all four seasons. No single environment dramatically outperforms or underperforms. Back-tested over several decades, this portfolio has produced strong, risk-adjusted returns with far less volatility than an all-equity portfolio, at the cost of somewhat lower absolute returns in the best of times. The action: compare your current portfolio allocation to the all-weather framework. Are you balanced across different economic environments, or are you heavily concentrated in assets that perform only in growth conditions? Chapter 5: The Psychology of the Unshakable Investor. The final chapters are the most important. Robbins argues that unshakability is not a quality of the portfolio, it is a quality of the investor. The most robust investment strategy in the world will fail if the investor panics and sells during a correction. He outlines the cognitive biases that undermine investment decisions: loss aversion, the tendency to feel losses twice as painfully as equivalent gains; recency bias, the tendency to assume that recent market conditions will continue; confirmation bias, seeking information that confirms what we already believe. The practical antidote is what Robbins calls the mindset of abundance, the deeply held belief that the economy will continue to grow, that markets will continue to create value, and that temporary declines do not represent permanent losses. This mindset is not naive optimism. It is grounded in historical data. But it must be actively cultivated because the emotional pull in the opposite direction is very powerful. He also emphasizes the power of perspective. Most market declines, when viewed on a long-term chart of the stock market's history, are barely visible. The events that felt catastrophic at the time, the 2008 financial crisis, the 2020 pandemic crash, are blips on a chart that has moved relentlessly upward over a century. The action: find a long-term chart of the stock market going back 50 or 100 years. Look at the crashes you know the names of. See how temporary they appear in context. Save this chart. Look at it the next time a correction feels catastrophic. Key quotes. The only certain thing about the financial markets is that they are uncertain. Every bear market in history has become a bull market. Freedom is the destination. Financial independence is the vehicle. Don't wait to invest. Invest and wait. Complexity is not a feature, it's a cost. How to apply this? The core message of Unshakeable is actionable immediately. Begin with the first principle today. A note at the end. Unshakeable by Tony Robbins is a book that rewards rereading. Return to it whenever you feel financial anxiety, not because it will tell you what the market will do next, but because it will remind you what matters and what does not. This has been WealthWorks. If this was useful, subscribe. There is more where this came from. Isn't good.